Hello, good morning, and you're watching Market Cafe on ET Now with me, Vinny Motiwala. Along with me is Lisa as well. Lisa, very good morning to you as well. Surely we are all excited about today's day. At least for me, it's going to be a long day, but a lot is going to be happening in the world of global markets as well. How are they shaping up like as of now? What is the handover they've picked up this morning?
It's the Treasury yields back again in focus, Vinny. Treasury yields are spooking the market yet again because it's at a multi-year high. It topped 4.9%, which is at specifically, it's at a high since 2007. And Treasury yields are rising since yesterday because on the back of strong economic data, the retail sales data that came in quite strong. So Treasury yields, if I look at it now, it's at 4.93% still. So even that has rubbed off on the housing rate, mortgage housing rate as well. It's at 8%, highest level since 2000. So that has caused some negative impact on the market. Dow is down around 1%. S&P, Nasdaq, that's more than 1% down, and Nasdaq has been hit the most, and it's coming at the right time because the Fed chair's speech, Powell's speech today, is coming at the right time because on one hand, inflation is showing an easing trend, but Treasury yields are rising. So, and market is also expecting the Fed to keep the rates, to hold the rates. The commentary coming in from Fed Harker's commentary says that the rates may stay at current level. Even the Fed Beach book that came in, that shows that economy is showing no change. The US economy is stable. So the Powell speech will provide some clarification on how the monetary policy will trend going further. Now shifting focus on the earnings was mixed because Netflix and Procter & Gamble, they reported good earnings. Netflix was up around 13% post-market, but other companies like Morgan Stanley, United Airlines, Tesla, they reported weak earnings. So yes, it was a mixed earnings bag. And talking about chip stocks, they continue to see pressure because this is on the back of US restricting the AI chips curbs to China. So yes, even chip stocks was seeing pressure, and stock futures, if I look at now, it's trading flat with a positive bias, and this is ahead of the weekly jobless claims as well as existing home sales which will be released today. Now shifting focus on the European market also closed lower. DAX, FTSE as well as Stock 600, it was down more than 1%, and chip stocks also fell on the back of ASML earnings. They reported very weak earnings. And talking about the inflation data, the Eurozone inflation that came in at around 4.3%. It eased from the 5.2% level seen in August, while the UK inflation that came in at around 6.7%, unchanged from the previous month. So that's largely the handover coming in from the US as well as the European market, where Fed Powell's speech will be in focus today, Vinny. But what about the crude as well as the commodity front? How are you picturizing that?
So absolutely, the concerns that you mentioned about the Israel-Hamas war that is going on as well. That's a big concern, and that was impacting the oil prices. And that is one concern that continues to be there because last night we saw a sharp rally coming in the oil prices. It was up as much as 2%. But this morning when we are seeing, there's a bit of a correction coming in the oil prices. Brent crude oil, yes, continuing to be about the $90 per barrel mark. As of now, it's trading at around $91 per barrel mark, a slight bit of a decline of almost 0.5%, you could say, for Brent crude oil prices. WTI crude oil prices also at around $88.10 per barrel mark as of now. So yes, so what we're seeing is a bit of a cooling off that is coming in the Brent crude and oil prices as well. Given that we've seen a sharp run-up coming in this week, the markets are waiting more developments in terms of Israel-Hamas, the global tensions that have been going on, while the upcoming signals from the Federal Reserve is something that they are focusing on and watching out for as well. And any escalation after the geopolitical tensions could actually again lead to an increase coming in the oil prices. So everyone's keenly watching out for these concerns coming in on that front as well. Other than that, also when you look at it in just terms of what GRMs are doing, Singapore GRMs have again seen a fall coming in. They're currently trading at $2.56 and this is the lowest levels that we've seen for Singapore GRMs since the 2nd of May. So let's keep an eye out on overall the commodity front as well. What is going to be shaping up on that front, because surely when you look at it in terms of Brent crude oil prices, slight bit of a correction. Gold prices also a bit subdued, not much of a move coming in this morning. $1,962 per ounce is what the gold prices is holding on to after the advance that we saw people shifting towards more focus of gold. This morning, a bit subdued in trade. So that's how commodities are looking like this morning as well. Those geopolitical tensions, Lisa, continue to loom a bit over a commodity side as well.
For watching that too. But let's shift focus on what are the important events lined up today. We have the US initial jobless claims, as I highlighted before, and back home the important earnings to watch out for will be the FMCG bigwigs. Nestle, HUL, ITC will be reporting their earnings along with other nifty constituent, that is Ultratech Cement will be reporting their earnings. On the corporate action front, it's the nifty expiry today. Satin Credit Care Board will be meeting to consider the fundraise. Voltas also will be considering the issuance of unsecured NCDs, and Sagar Cement will be considering pact with AVH Resources. Nestle will be considering the subdivision of its equity shares, and specialty restaurants will be considering the allotment of shares. On the other events, Jerome Powell will be speaking at the Economic Club of New York Cricket World and the Cricket World Cup 2023 between India as well as versus Bangladesh will be held today.
That's all the important cues to watch out for as well. But let's look at some of the important headlines that are coming in on the global front as well. And obviously, the latest on the geopolitical front, deadly Israeli air raids continue to pound Gaza overnight as residents mourn the deadly strike at the Gaza hospital. Almost 3,500 Palestinians have lost their lives since 7th of October. US has vetoed a UN Security Council resolution condemning Hamas attack while calling for a pause in the war to allow humanitarian aid into Gaza. 12 members voted in favor of the draft text, while Russia and Britain also abstained from anything. Now, in terms of Russia, had proposed a resolution calling for a ceasefire earlier this week, but it was rejected. UN has also said that as many as 1 million people have been displaced because of the war. And just a day after US President Joe Biden's visit, UK Prime Minister Rishi Sunak will be on a 2-day visit to the war-torn Israel, meeting Israeli Prime Minister Benjamin Netanyahu and President Isaac Herzog. Now, Sunak will also be urging for opening up of the route or to allow humanitarian aid into Gaza as soon as possible, and to enable British nationals who are trapped in Gaza to leave as well.
And all focus on China because China released their GDP data, and Chinese economy grew at a faster rate than expected in the third quarter, and that has led brokerages to raise their 2023 forecast. Now, the only outlier being Goldman Sachs that has gone ahead and cut its view to be in line with the peers. All the 6 brokerages, as you can see on the screen, they have pegged their estimates above Beijing's 5% growth target for the year.
And Morgan Stanley shares took a beating after the third quarter results that topped profit estimates on a better than expected trading revenue. Now, trading operations helped offset the revenue miss. Investment banking division accounted for yet another miss in the quarter gone by, generating $938 million in revenue.
And Tesla delivered a miss in their Q3 results, and this is after the EV maker unleashed a wave of price cuts that has weighed on their margins. Gross margin slipped to 16% quarter on quarter, and going forward, they expect to deliver around 1.8 million vehicles for the year. However, streaming giant Netflix shares that surged after profit beat expectations. The company also reported a boost in its subscriber growth, and that was driven by their recent password sharing crackdown.
Let's move on, talk about Google, because Google has slashed dozens of jobs from its news division. Now, according to reports, an estimate of 40 to 45 roles have been eliminated from Google News. The cuts come at a very sensitive time for online platforms as well as publishers.
And those were the global highlights. But with that, let's slip into a short break where post the break, we mark the Asian market. So stay tuned on the show. Welcome back to the show, and we are on that part of the show where we should focus on what's happening on the domestic front. So let's shift focus on the earnings. A poor show on the earnings front for Wipro. The tech major has reported lower than expected revenue as well as profit for the second quarter. And in signs of more troubles ahead for the company, Wipro has forecast Q3 revenue at 3.5% to negative 1.5%. And my colleague Anisha Jain, who tracks Wipro closely, joins with more details on this.
Well, Wipro has managed to disappoint yet again. The guidance has come in towards the lower end of what Street was expecting. They're talking about a decline of anywhere between 3.5% to 1.5% for the coming quarter. And this is coming on the dismal performance that we have seen in Q2 as well. The constant currency has actually declined by 2%. This too is at the lowest end of the range that the company had guided. The Street was expecting the cut is going to be around 1% in terms of constant currency. It's actually lower than that. Margin is something that the company has managed to hold on to. But if you look at the profit figure as well, it's a miss versus our expectation, and that's because the top line itself was weak. Even if you look at the headcount figure, that's gone down by almost 5,000 employees, and this is coming after the big 8,000 cut that we had seen in the earlier quarter. So if you look at the year-on-year number as well, there's a sharp decline in the number of headcount, and this is despite the attrition also coming off quite a bit. So clearly that tells you that the kind of momentum these IT companies are expecting going forward is going to be weak. Having said that, the only silver lining, if at all, in the earnings is the fact that the deal bookings have remained quite steady at $3.8 billion. It's a little higher than the average that we have seen over the last 6-7 quarters. So deal bookings continue to be quite strong for the sector, but it's a guidance which is weak, which is pointing to a weaker H2, and especially Q3 guidance is not anything to go by in terms of anything positive for the outlook.
Okay, thank you so much for that, Anisha. But let's also listen into what the management had to say on the back of their earnings as well.
No major change with the previous quarter. We continue to be in this market with, a certain level of uncertainty that is slowing down, not so much the demand in total, but just the discretionary spend. And we are seeing it across industries. We've seen this pattern for, 2-3 quarters now. And, while we do a strong performance in terms of bookings in TCV, we've won, a lot of new deals. We have won, two $500 million deal, and yet the volume of discretionary spend continue.
Well, coming to you, Aparna, then margins have managed to hold steady. Going forward, given the seasonality and wage hike impact, do you expect the quarter 3 to be a much weaker for margins?
We don't guide for margins, like We are seeing the headwinds play out in terms of, a softer revenue environment. You've seen our guidance. There are furloughs. Quarter 3 is a seasonal quarter with furloughs, and we are rolling out wage hikes. So yes, it is going to be a challenging task. We have several measures that have been put in place, and we will try and put up a defense on our margins. And what theory is shared is that we are likely to be range bound in line with what we've delivered over the last few quarters.
Moving to Saurabh, then when will the wage hike roll out, and what will be the level of hikes and variable pay then?
Our wage hikes will be effective 1st of December of this year. We will do it broad-based but selective, based on performance, based on criticality. So we will be doing that effective 1st December. Our variable payout will be in line with what we have done in the previous quarters, although it depends different business units on their performance. But all around 80% is what our employees would be getting as variable pay for Q2.
Well, on the back of poor show coming in from Wipro, even the brokerages, they sound quite bearish on the stock, because Citi has come out with a note on Wipro. They have maintained a sell on the stock. They have cut the target price to 360 from 385 earlier. They said that this is on the back of poor performance by Wipro on all counts. And even the forward-looking indicators, that also looks quite challenging. So they have cut the estimates by around 7% for FY24 and for 25 as well as 26 respectively, they have cut it by 2%. And another brokerage, BofA, also has maintained an underperform on the stock with a target price of 350. They say that on the back of the earnings coming in below the estimates, and even the macro and the seasonal impact, that makes it challenging for Q3 guidance that stands weak, and even the higher wins through partnerships, more to go for the partnership. So even that looks quite challenging for Wipro. So that's the brokerages talking about Wipro. Quite a bearish stance coming in from the brokerages.
Okay, let's move on and talk about some of these other earnings that have come in on the IT front as well. First one is LTI Mindtree. They posted a fairly healthy set of numbers in quarter 2, and the profits and the margins beat the estimate despite the wage hike. And the management is also confident about the second half being better, and the CC revenue growth also came in as the street was expecting and about the street expectations. While in terms of attrition, slightly eased and the deal wins remained a bit healthy, the company has also announced a dividend of ₹20 per share as well. So we are surely keeping an eye out on that one. But let's also listen in to what the management had to say. We had Debashish Chatterjee who was talking. So listen into what the management had to say on their earnings.
All the opportunities that we have been focusing on and the deals that we have closed in the last 2 quarters, they seem to be ramping up well, but of course that is offset by some furloughs and some pressures in terms of the cost takeout in the existing book of business as well. We have also baked into the fact that there will be larger than average furloughs, and which is going to be extended beyond BFSI. So keeping all these things in mind, we also have closed opportunities in Q1 and Q2. And all the deals that we have closed, I think they are going to ramp up very nicely in the next 2 quarters. That gives us the confidence that, and there is a significant, deal activity right now as we speak, as far as Q3 is concerned. And we expect many of them to close in Q3 as well. So given all those things, the strong pipeline, the deal momentum and the activity, and the deal closures that we had in the last 2 quarters, which are ramping up nicely, we have the confidence to say that H2 will be better than H1.
Okay, let's move on and talk about another IT company that reported its numbers right now. You can see it flashing on your screens as well, and that is Coforge. Now, Coforge, when you look at the profits of the company, they are seeing a growth on a quarter-on-quarter basis. I beg your pardon. Profits have come in at 181 crores versus 165 crores. So growth in terms of profits. Revenues of the company 226 crores versus 226 crores versus 2,210 crores, increase on a quarter-on-quarter basis as well. What we're also seeing in terms of the margins, a slight bit of an expansion that is coming in terms of the margins of the company. I'm just going to be opening the press release to read some more details in terms of what is happening in terms of any attrition rate that we have, or any details from the presentation if they have come in. But as of now, okay, we do not have the presentation, but seems like a decent set of numbers. Let's not forget that Coforge was a bit down and out in trade before its earnings as well. Nothing exciting was happening in terms of the stock price. So surely we are going to be keeping an eye out on how Coforge does in trade today. Seems like a decent set of numbers at least has come in on the first cut of the company, and nothing bad in terms of margins, because margins also have seen an improvement coming in. Also, when I'm talking about, okay, we do have the order intake that has come in at $313 million. That's a 7th consecutive quarter that the company has seen deal wins above the $300 million mark as well. Total order book is around $935 million, which is up on a 16% on a YOY basis. They've added 8 new clients during the quarter as well. The headcount at the end of the quarter is saw an increase coming in at 24,638. That's the addition, and the LTM attrition is at 13%, which is down 340 basis points when you compare it on a year-on-year basis. That's the word that we have gotten in terms of the Coforge as of now. Let's keep an eye out on that one, Lisa.
Well, yes. Now we're shifting focus from IT to banking. IndusInd Bank has reported a healthy set of numbers for the second quarter. Both the revenue as well as profit, they have come in line with the street expectations. Profit has risen nearly 23% sequentially to 2,200 odd crores. Meanwhile, there is some improvement on the asset quality front, because the NPA that has come in at 1.93% versus 1.94%, quite stable in the previous quarter. So Harsh, who tracks IndusInd closely, joins with more details on this.
Well, yes, absolutely. Steady set from IndusInd Bank, largely in line with expectations. NII came in at 5,077 crore. We had a number of around 5,000 to 5,050 crore in our book picked up. So, have to, of course, therefore see the impact of that on operating profit, though operating profit came in slightly softer than what we were expecting, but in line nonetheless. Operating profit came in at 3,909 crore versus the 4,000 crore number that we had looked at. 6% uptick in OPEX was the reason for that. So you're seeing significant investments being upfronted by IndusInd Bank. Provisions came in at 974 crore, which is a downtick of roughly 2% sequentially, largely in line with what we were expecting. And profit after tax came in at 2,200 crore. We were expecting a 2,250 crore number. So that too pretty much in line. So it's a steady set overall. In terms of what the management continued to reiterate, you had NIMs, net interest margins, which were flat sequentially, 4.29%. That's definitely a plus given the environment, and what the management seems still confident of is to maintain NIMs in that 4.2 to 4.3% band. What they are suggesting is cost of deposits will go up by around 20 bips or so, but they're going to be able to defend that. They also have excess liquidity of around 37,000 crore, which they will reduce to roughly 20,000 crore odd. So that will also add to the or rather reduce pressure on the margins and add to the positivity on the margins. Also, what they are suggesting is cost to income will start coming off to that 43 to 45% band. They are positive on that one, and therefore they suggest that operating leverage will start kicking in. CASA, which has been softer, management suggests that it will start coming back in another couple of quarters or so, and they are expecting retail slippages which were higher this time around, on the higher side. That's the one negative piece of all of the results that came through. They are expecting retail slippages to also start coming down sharply going forward.
Well, thank you for breaking down the numbers for IndusInd Bank, Harsh. The healthy set of numbers for IndusInd Bank that has been reflected in the brokerage's view as well. They are quite positive on IndusInd Bank. So BofA has maintained a buy on the stock, but they have hiked the target price to 1,750 from 1,650 earlier. They said that Q2 has ticked most of the boxes, and with that, the re-rating thesis that remains intact for the company. And healthy loan growth improvement has been across the segment, and also stable NIMs as well as credit cost is expected to decline further in H2. And the second brokerage, Macquarie, is also positive on IndusInd Bank. They have maintained an outperform with a target price of 1,580. They said that quarter two, that was in line, but that was driven by dipping of the contingent provisions. But the asset quality, though it remains stable, but still it requires monitoring. And they continue to believe that IndusInd Bank can deliver ROA of around 1.9%, and that is on the back of its high margin structure. So that's largely what brokerage is saying about IndusInd Bank, Winnie.
That's IndusInd Bank, but we also had Bajaj Auto, which reported its numbers. How are the numbers looking like? Seemed like the profit surge as much as 20% on an annualized basis in this quarter. What more are the details? Let's go across to Shrishti, who's here to give us this fine print. Shrishti?
Well, Bajaj Auto continues to outpace the street expectations, and once again a record quarter for the company, wherein the revenue as well as EBITDA has come in line to the 80 now estimates. But what a strong beat onto the margin figure, because this time we were expecting the EBITDA margin at 19.4%, and that was the key number to watch out for, when 19.7% is what the company has reported. Other than that, if we talk about the profit figure, then a beat on that front as well versus our expectation of 1,771 crores. The company has reported 1,836 crores in the bottom line. When it comes to the margin growth in the company, attributes factors like better realization and a richer product mix, which has helped the margins of the company, despite the fact that the company has been investing in their electric scooter division. But a couple of more highlights from this earnings is where the company says that the export stays on course to make a gradual recovery. They did launch their E3-wheeler in select geographies. They are receiving an encouraging response to that, which has led to advancing of their rollout
rollout plans. And lastly, some of their new offerings, and one of them is Triumph Speed 400. The deliveries were initiated in the month of August itself, wherein more than 8,000 units have already been delivered, and that's the latest coming in on this front. So beat across all the parameters from Bajaj Auto, a strong performance onto the margin figure, definitely a positive read-through for the rest of the two-wheeler companies as well.
Well, record quarter for Bajaj Auto. It will definitely be in focus today. Thank you for that, Srishti. But let's see what brokerages are also talking about Bajaj Auto. BofA has maintained a buy on Bajaj Auto at a target. They have hiked the target price to 5,950 versus 5,550 earlier. And this is on the back of the exports recovery, which is expected, though it will be gradual. And the payout policy will be also including buyback. And they also see scope for the valuation re-rating going forward for Bajaj Auto. Three-wheelers which stood out in this quarter, that has set the wheels in motion for Bajaj Auto, and also so largely on the back of export recovery, good quarter, BofA is quite positive on Bajaj Auto, which will be in focus today.
Absolutely, but let's move on, Lisa, and also talk about an unlisted player. We have PhonePe that came out with its FY23 numbers. The digital platform has registered rupees 2,914 crores as the income that came in for FY23. So revenue rises by 77%, and there's a growth on a year-on-year basis versus last year for the revenues of the company. Now, also when you're just looking at it in terms of the losses of the company, seems like the losses of the company have widened a bit, and that is mainly because of the higher ESOP cost that has come in for the company. So when you look at it in terms of operating loss, that's at 1,755 crores in FY23 versus 1,612 crores. So clearly a widening in terms of the losses we are seeing, mainly due to the increase in the ESOP cost that was and one-time rewards for setting up, incentivizing new businesses. That's the impact that is coming in on the bottom line of the company as well. So keeping an eye out on overall PhonePe in terms of the numbers for the digital platform as well. As of now, this is the indication that we're picking up, and obviously furthermore, what we are also understanding that mobile recharges as well as bill payments have driven the growth in terms of the revenue of the company. And furthermore, the company also highlighted and they added that the smart speaker sales stood at 4.1 million as of the month of August as well. So let's keep an eye out on that.
Well, with that, now let's slip into a short break. More stock-specific news on the other side of the break, so stay tuned on the show. Welcome back to the show, and thank you for staying tuned in. Well, now shifting focus on the earnings. A slew of FMCG earnings have been lined up. And what is the street expecting from HUL, ITC as well as Nestle? Vinny is joining in with all the details. Vinny, what are the expectations from these FMCG bigwigs?
Absolutely. So let's start with what we're expecting in terms of the growth as well as the volume growth of the company as well. When you look at HUL, ITC, both expecting around a 4 to 5% growth in terms of revenue on a year-on-year basis. Nestle, a stronger growth. We're expecting good earnings coming in from Nestle, 12% growth in terms of the revenue of the company. When you look at the volume growth, expect to be in that mid-single digit range. HUL has reported this 4%, 3 to 4% volume growth even in the last couple of quarters. So that range is expected same for HUL as well. So 4% growth, volume growth in terms of HUL, ITC cigarette volume growth expected at 5% and Nestle volume growth at 6% as well. Margin expansion across the three companies because of raw material price seeing a bit of a easing coming in terms of the cost over there. So inflation is reducing, and because of that we're seeing margins will see an expansion. For HUL, when you look at it, we're only expecting a 60 basis point margin expansion. Why? Because specifically there is that royalty payment, higher royalty payment, which is impacting the margins a slight bit over there. Other than that, specifically in terms of HUL also, what we're expecting that is owing to the royalty payment, that margin impact. Home care and personal care segment, that's expected to see an improvement going forward, and pressure is likely to continue in terms of the HFD segment, which has been under pressure for the last couple of quarters. So keep an eye out in terms of commentary that would be coming in from the HFD segment. What is the competition from regional players is important to watch out for in terms of commentary. That was something that impacted the stock last time as well. So keep an eye out on that. Now in terms of ITC, obviously we're expecting strong performance coming in from the cigarette side and FMCG business. Agri business and paper business expected to be muted. So obviously, cigarette business, FMCG business, strong growth will offset the weakness in agri business as well as paper business. Other than that, let's watch out for any update coming in from the hotel business. We're expecting strong growth in the hotel business, but more update in terms of the progress of the demerger. That's something to watch out for as well. Commentary is also going to be watched out in terms of the out-of-home consumption coming in from ITC as well. Lastly, in terms of Nestle, let's watch out for, what is happening in terms of the milk and nutrition segment, the commentary on that front. How is the out-of-home consumption trends? What is the positive operating leverage that is actually benefiting the margins? Are key factors to watch out for from Nestle. When you look at the stock move also, HUL has been a clear underperformer versus an ITC and a Nestle. So pulling up the stock move, yes, Nestle has done well, ITC has done well as well. And PE, valuations is something that is for, when you look at it for HUL or an ITC, HUL has seen a correction in terms of valuations in the last YTD basis, when you look at it on the last 1 year basis as well, versus an ITC and a Nestle. Look at Nestle, much at a premium versus HUL. Seems like it is priced in terms of the good earnings that we're expecting there for Nestle. So keeping an eye out on all these three companies today.
Well, we'll definitely keep an eye on these three FMCG companies today. Thank you, Vinny, for sharing what's expected and the factors to keep a watch on these companies. But shifting to another nifty earnings that is Ultratech Cement, which will be reporting its Q2 numbers today. Strong set of earnings is expected to come through, and that will be on the back of a strong base as well as a relatively low monsoon. Now, Ashesha is here with all what's expected and what the street is penciling in for Ultratech Cement.
Well, yes, we are expecting strong set of numbers from Ultratech Cement this time on account of a low base and weaker than expected monsoon that aided construction activity in the quarter gone by. Company has reported a strong volume growth of about 16% on a year-on-year basis, which is much better than the industry average of 15%. As far as numbers are concerned, consolidated revenues could come in at about 15,800 crores, up 14% on a year-on-year basis. Margins too are expected to expand by about 240 basis points. We are expecting margins to come in at 15.8% versus 13.4% that the company had reported same time last year. On a sequential basis, realizations are expected to be flat, while EBITDA per ton is expected to fall by as much as 7% on a quarter-on-quarter basis, and this is on account of flat realizations and negative operating leverage that kicked in the quarter gone by, partially offset by lower power and fuel costs that the company experienced. All in all, second quarter is usually a seasonally weak quarter, but this time around things were better on account of weaker monsoon, and hence we are expecting strong set of numbers on a year-on-year basis, although sequentially we will see a decline as far as realizations and EBITDA per ton is concerned on account of negative operating leverage.
Thank you for that, Ashesha. So year on year, we'll see strong numbers for Ultratech, but sequentially it will be some pressure will be seen on the back of margin. But shifting focus on the fintech companies, which will be in focus today, Citi has initiated a stance on a couple of fintech companies, and also Jefferies has initiated a buy on Paytm, and this is on the back of Q2 earnings. So let's go across to Vamakshi. She has all the details on this. Vamakshi, which are the companies that will be in focus on the back of these initiating reports?
Well, yes, let me first start off with CAMS as well as KFin. We have a note coming in from Citi, and Citi has highlighted that the bargaining power is negatively skewed in a duopoly. They do see some high potential coming in from the new business, and in fact, the mutual fund revenues are expected to dominate this. However, when we talk about it from a cost perspective, the investments that they have been making in terms of diversification could be a drag on their earnings. So, all in all, what Citi has highlighted is the fact that CAMS as well as KFin's current 33 to 30 times of FY25 EPS respectively could likely ignore yield pressures in the domestic mutual funds and as well as cost drags from the new businesses. So given all of those factors, Citi has actually gone ahead and initiated coverage on both of these counters with a sell rating. For CAMS, the target price is 2,200 rupees per share, while for KFin it is nearly 435 rupees per share. Other than that, let's also focus in on Paytm. We have a note coming in from Jefferies, and Jefferies has highlighted that the transformation has supercharged growth for Paytm and in fact has upfronted profitability for this counter. Growth momentum is expected to continue, and in fact the contribution profits as well are expected to expand faster for Paytm by almost almost 40% CAGR. Asset quality gains are also visible from rising share of credit tested users, and in fact the company is poised for sustainable growth, and the valuations for this counter according to Jefferies also look quite attractive. So given all of those positive factors, Jefferies has gone ahead and initiated coverage on Paytm with a buy rating, target price of 1,300 rupees per share.
Well, thank you for that, Vamakshi. Thank you for taking us through that. So keep an eye on the fintech stocks as well as all the stocks that we highlighted during the course of the show. But with that, it's time to wrap up on this edition of Market Cafe. But do stay put on the channel as we catch all the action on the market. Goodbye and thank you for watching.